Welcome, everybody. Thanks for taking the time this afternoon. Hopefully, everybody has a good, healthy, nutritious lunch in front of them right now. Welcome to I think we talked about this. This is our third annual Lutz Financial Year-End Review and Market Update. We've done this and it's had some pretty decent feedback over time. So please keep that feedback coming and make sure this is worth your while and something that you guys enjoy. Our caveat, as always, is this is an educational session. It is not investment advice or market advice, anything like that. This is a strictly educational session. And then as you guys have questions or anything, we're going to reserve some time at the end. So, but you can do it as you go along and insert those questions in the chat. Nobody else will see them but us. And then at the end of it, we'll answer some of those or hopefully all of those questions that you guys may have. My name is Justin Vossen. I'm one of the investment advisor partners at Lutz Financial. Lutz Financial is about a $2.8 billion investment advisory firm. The main thing we do is work with individuals and then 401k and company retirement plans are the two things that we really do. I'm here with Josh Jenkins, who's our Chief Investment Officer. He's going to be taking you through the market update and one of our partners as well. And we're just going to dive right into it. So the agenda today, Josh is, like I said, going to take you through kind of where we're at in the markets and some of the themes and things that we're seeing there right now. And then probably I'm going to come in on the backside and talk some year-end financial planning strategies. As it relates to portfolios, as it relates to taxes, since there's been so much tax change this year, and then just some year-end financial planning considerations that we think everybody could take some time to look at. And, again, hopefully as you learn through this and as we bring up some different various topics, we're covering the gauntlet from, different income levels to different tax issues and everything like that. So we don't know where everybody's coming from, but hopefully you get one or two things that you can take away from this and apply it to your world and at least seek out some other help if you have any further questions. So with no further ado, we'll take you through again, Lutz Financial and Lutz was founded in 1980. We've got 3 offices here in Nebraska. If you're not familiar, here, Lincoln, or here, Omaha, Lincoln, and Grand Island. There's about 375 employees. Again, we're part of Lutz Financial, which is a subsidiary and SEC registered investment advisor. But most of our firm comprises of a lot of accountants and technology folks that can help with any of that. Again, we're on the financial side. We also have a talent organization and some HR management that can help you with your employees. So, our network is pretty vast and we've got a bunch of different things going on. So obviously reach out to one of us at the contact level if you have any questions and we can put you in the right direction over time for the advice and the help that you're seeking. So without further ado, Josh, you take it away on the market side.
All right. So on the market side, we've got a lot to cover in kind of a short amount of time. So I'm going to start off just kind of set the stage a little bit, and then we'll bounce around between some hot topics that we're kind of seeing in the news right now. But to start with, I wanted to put this chart in front of you. We're looking basically at S&P 500 returns over the last kind of 6 years. And I wanted to provide just a little bit more of a longer term view, a little context of how we got to where we are today. You see the list on the right is a lot of sort of the big events and some of the things that have kind of driven market commentaries over the last few years. And, what you see is since 2019, it's been a pretty eventful period, right? We went through COVID. We had the inflation spike that followed it. We had some, the strictest monetary policy we've seen in a couple of decades. We've had some pretty nasty, trade disputes. There's been a couple of wars. We went through some regional banking crises. And most recently, we've seen the Fed kind of cutting rates. And really, I think what we're trying to show here is it's been a really eventful period.
Just 5 years.
A lifetime worth of events in just a 5-year span. But I think what's interesting is you can kind of look at a 5-year window anytime over the last 100 years, and most of the market charts are going to kind of look like this, right? There's a general trend up to the right. but it's going to be punctuated by these big events, these big volatile periods, these recessions. But normal is generally, slow and steady growth. And when we kind of have some of these market update conversations, talking about the current events and what's in the news flow, I think investors can get really caught up in some of these shorter term stories that seem like a big deal now, but when you kind of broaden out and take a broader view, most people aren't going to remember some of these things. It's not going to have a meaningful, lasting impact on investors. So, kind of want to start with this chart just to provide that caveat. Because again, investors have a lot of noise to deal with, and that's kind of what we're trying to show with this slide, right? We went on YouTube and we pulled some screenshots from some different CNBC videos over the last couple of years. And, I think the financial media is a big source of noise. Obviously, fear attracts viewers, so there's a lot of incentive to populate the programming with content that unnerves people. And then if you're an economist or a strategist, there's a lot of incentive, I think, to make one of these big calls, right? Call the next market crash, call the next recession. It's a way to kind of solidify yourself and make you kind of a popular and important figure. And it's a big career boost. And so I think what you see is basically a steady course of people throughout time who are trying to make these big calls. The problem is both the economy and markets generally sort of press forward, right? So you see these calls all the time. Oftentimes they're not correct. And you kind of look at the scoreboard.
Most economists have predicted like 10 out of the last 2 recessions.
Yeah, that's exactly right. The recession always seems to be just around the corner, right? It's always next quarter. It's always next year. So over the last 3 years where we've been getting these calls, again, if we look at the scoreboard, you can see, these calls have been way off base. If we're looking at economic growth, measured here as real GDP, compared the last couple of years compared to sort of the longer term average, you can see 2023, 2024, 2.9 and 2.8%. That's materially above that long-term average. 2025, we only have data for the first 2 quarters. That's an annualized figure. Q1 was a little bit weak. It was actually slightly negative. Q2 was a positive 3.8%. That's a very strong annualized figure. And if you look at the Atlanta Fed has a widely followed model called GDP Now. It's basically a nowcast of what the current period's GDP is going to be. Right now, it's projecting Q3 GDP to be, again, 3.8%, similar strong as Q2. So certainly any call for a recession in recent years was unfounded. And it's kind of the same story for the stock market. Here we're looking at the S&P 500 index as a proxy. Long-term stock market returns tend to be about 10% per year on average. You look at the last couple of years, 23 and 24 were north of 25%. In 2025 through Q3, we're up 15%. So if you compound those returns together, that's an 80% return. An investor basically came close to doubling their money. And this makes to me a very, very important point. And that is, yes, there's always risk in the market. The market is cyclical. The economy is cyclical. There's going to be a recession eventually. These guys are going to be right eventually. But you can lose more money by sitting on the sidelines and missing out on these gains than you would if you just rode the downturn and waited for the recovery. There's a lot of risk in terms of opportunity cost if you get caught up in some of these forecasts. We're going to have another downturn eventually. If you've got a good diversified portfolio and financial plan, it's going to be designed with that in mind. You're going to be able to write it out.
And all those forecasts and predictions sound smart, and there's a lot of reasons behind them, and often, compelling. But at the same time, the point is making sure you've got, reserves and other investments out there that can weather through these inevitable storms, which we're going to see another recession at some point.
Sure.
I have no idea when. And that's the whole point. You don't have to pick it.
Importantly, these forecasters, none of these guys have a crystal ball, right? We don't know when the next one's coming. They don't know either. It's their job to guess. And if they guess right, they're going to be a little bit more famous and be on CNBC a little bit more often. But their job is to play that game. You don't have to. Okay, so something that's definitely in the news a lot right now is the government shutdown. And I think we would put this squarely in the noise bucket. We've been through this many times before, a couple of dozen times in recent decades, a few times within the last decade, even some of the longer lasting shutdowns we've seen here fairly recently. And look, if you work for the federal government, if you do business with the federal government, if you rely on data that's published by the federal government, this is, disrupting to your life. I don't want to downplay that in any capacity, but from an economic standpoint, the economy is missing out on some activity while it's closed. But what we've seen in past iterations of this is the economy makes up for that lost activity the second the government opens. And here in the chart that we're looking at, you can see S&P 500. So again, our proxy for the US stock market before, during, and immediately after these shutdowns. And there's no pattern here. There's no obvious, like this is a massive negative for the markets. These return figures look generally pretty random. The most recent couple of episodes, you've actually seen positive market performance. In our view, this is a non-event. We think when push comes to shove, they'll come together and make a deal. It's going to be reported on a ton, but from a long-term investing or economic standpoint, we're not really concerned about it.
And I would just say, as an aside, with dealing with my clients and just people in general, politics are on a heavy volume these years. And again, I'm not picking a side at all, but I think that noise has become really hyper prevalent in affecting people's thoughts on the market and everything like that. And traditionally, if you look at some numbers, it doesn't really matter who's in charge. And again, that's another argument, but at the same time, a lot of this is kind of noise, and you just got to kind of weather through it as well.
Yeah, definitely. Another sort of storyline that drives a lot of the news flow as of late and probably over time is monetary policy, right? We've seen a shift in monetary policy recently. What we're showing you here in this chart is the federal funds rate over the last, call it 70 years. So we're trying to provide a little bit of a long-term perspective. The Fed funds rate is the Federal Reserve's primary policy tool. So when they're enacting policy to try to achieve their mandate, this is the primary tool that they're using. Kind of as we touched on earlier, coming out of COVID, we saw a spike in the rate of inflation. And the Federal Reserve, I think, admittedly, was late to kind of come to that realization. They initially thought it was transitory, but kind of when they joined the, hey, this is the problem sort of line of thinking, they acted pretty fast and they rose interest rates. They rose their policy rate to the highest level it's been in 25 years, and they did so very, very quickly. Since then, we've seen some improvement on the inflation front, right? The rate of inflation declined. You hear it in the financial media is referred to as disinflation, right? A slowing rate of inflation. And so at around this time last year, they actually started to cut rates. So they went from basically 0% to above 5%. And then the waning months of 2024, they dropped it by 1 percentage point. We have been most this year because by the time they got into early 2025, progress on inflation stalled, and so they stopped cutting. And then obviously, if you've been kind of watching the news, you've seen that they've restarted those cuts at their most recent meeting, and we'll kind of get into why that is the case here in the next couple of slides. Before we kind of talk about the why, we'll just look a little bit at kind of what's the expectation going forward, right? What's the future path of this rate going to be? And there's a variety of places that you can look to get a gauge of what expectations are. One is a market-based expectation. So you can look at the way that federal funds futures contracts. So there's a derivatives market that trades, future prices for this overnight rate. And basically how, by the way the traders are positioned, you can basically determine an implied expectation for what the rate's going to be in the future. As it stands right now, the way that they're positioned would imply that there's going to be another 0.5 point of interest rate cuts before the end of the year. Most people would generally expect that would come in the form of a 25 basis point cut at each of the final 2 meetings of the year. So there's one in late October, and then the last meeting of the year is in mid-December. So right now the market is expecting a 25 basis point cut at each of those 2 meetings. You can also get a sense of expectations by looking at the Federal Reserve itself. So the body that actually has the discretion, the decision-making authority over the level of interest rate, publish its own sort of expectations. So once a quarter, they do this within a document called the Summary of Economic Projections. And within that document is something called the dot plot. And that is basically a scatter plot that illustrates all of the individual FOMC participants or members, what their expectation is for the Fed funds rate at each of the next couple of years. So they published an updated version of this a couple of weeks ago at the most recent meeting. And basically looking at this, the median estimate, which is generally taken by the market as sort of a proxy for the Fed's expectation. It's also penciling in 2 more cuts this year. Again, the market overwhelmingly looks at that as 2 25 basis point cuts. So we see the market and the Fed both in line, at least right now, in terms of expectations. And the Fed would say, if they cut 2 more times, that would still leave their benchmark rate in modestly restrictive territory. Well, how can you tell that that's the case? Well, one, Chairman Powell will tell you, and basically every time he speaks, he makes those comments. But 2, within the SEP, the Federal Reserve puts down their estimate of something called the longer run rate. And so if you believe that high interest rates restrict economic activity and low interest rates stimulate economic activity, there has to be some neutral level in the middle that neither restricts or stimulates. That's generally referred to as, again, the Fed in this document calls it the longer run rate. You might hear it in the media or from an academic call it the neutral rate, the natural rate, or even R star is kind of a technical jargon for it that you will hear people say. The estimate for that currently is 3%, right? So even after 50 basis points of cuts, we're still modestly above that. That's signals that the Fed thinks we're still modestly restricted.
And it's probably not coincidental that that's 3% the long run inflation rate over history too.
Mm-hmm.
That's probably a neutral rate. I think that's what they would say too. Probably not overtly.
Yeah, over the very long term, for sure. So what's driving the Fed's decision? You know, what is going to go into the decision-making process over the next 2 meetings? Well, when you hear the Federal Reserve talk, when you watch Chairman Powell's press conferences, you'll hear them say all the time that they're data dependent. So which data are they depending on, right? What are they watching? And I would suggest that the data that's most important relates to their dual mandate. So by law, Congress has mandated the Federal Reserve to pursue maximum employment and stable prices. So their job is to make sure that the labor market is healthy and that the price level of goods and services are relatively stable. And so the data that they care about relates to these 2 items. And you can kind of see popular and important data points related to each of those 2 mandates. Above, we're looking at the unemployment rates, and we're looking at the PCE figure, which is the Fed's preferred measure of inflation. I think CPI probably gets the most press coverage, but it comes out earlier in the month, right? I think the Fed's big challenge is action taken to support one of their mandates can oftentimes push them in the wrong direction on their other mandate, right? If the labor market's weak and they try to stimulate that with lower rates, that could goose prices and generate some inflation. Conversely, if inflation's running hot and they try to put the brakes on that by rising rates, that could damage the employment market, the job market. So the Fed will pay attention to and talk a lot about the balance of risk, right? If they can only focus on one part of the mandate at a time, which one is presenting, the clear and obvious danger to the economy at any time? And I would say since COVID, it's basically been pretty clearly inflation, right? Inflation spiked to the highest level since the 70s or 80s. Clearly that's problematic. And so their energy and efforts have been focused on bringing that down. During that period, the employment, the job market has been relatively strong. Unemployment's been generally low. Job growth has generally thought to have been pretty strong. It's slowing now, and we've had some data revisions that suggest maybe in the recent history it's not quite as strong as we thought it was. But what's interesting is the Fed paused rate rate cuts in early 2025 because inflation stalled. Well, inflation right now is actually running hotter than when they paused. And the reason is that balance of risk seems to have shifted from the inflation side to the employment side. The Feds now believes that weakness in the labor market is now maybe a bigger risk to the economy than inflation, where it's at, even though it remains above their 2% target. They're now becoming more concerned with the jobs market, and that's why they're now resuming interest rate cuts despite inflation being higher than it was when they paused. Again, they're data dependent. We'll see how the data sort of progresses over the next couple of months. So what does all this mean for the bond market? Well, obviously the level of interest rates is critical for the bond market, because when you're looking at investment grade bonds, the best predictor of future returns is the starting yield on those bonds. And that's the relationship that we're charting and presenting here. We're looking at, since the 1960s, the yield on the 5-year treasury, that's the blue line. And then the green line represents at any point what the return on 5-year treasuries would have been for the next 5 years, right? So that's why the green line basically ends 5 years before the blue line does on the right-hand side of the chart, because obviously we don't know what the 5-year return is yet. It hasn't happened yet. But clearly this is it's not a perfect one-for-one relationship, but man, that's a strong relationship. Those two follow each other pretty closely. Most of the time since the financial crisis, the Federal Reserve has kept interest rates near zero, right? And so that's put a ceiling on longer term interest rates. That has put a ceiling on the bond market's expected return. After they raised interest rates to above 5%, clearly that caused a lot of pain in the bond market. Bond prices moved inversely with yields. There was a lot of upfront pain with that move, but the benefit to bond investors is now going forward, since starting yields today are higher, expected returns in the future are higher. So long-term bond investors are better off taking that upfront pain and then enjoying those higher coupons in the future. Now we view bonds, the role of bonds is to help manage risk within a portfolio, calibrate risk to a level that's appropriate with each investor, to manage liquidity, things of that nature. So for many investors, bonds have an important role to play regardless of what their expected return is. It just so happens today, the expected returns are higher than they've been in the last 20-25 years. So if you're a bond investor, you should be pretty happy with the outlook for bonds. Switching gears and talking about the stock market, we kind of looked when we were going over the actual scoreboard for GDP in the market. We saw that for the last 3 years, the market's been on a bit of a tear, right? Above average returns, well above average returns. Well, a consequence of that is the market has been pushing to all-time highs. And I think that has a lot of investors on edge. I think there's legitimate intuition behind why an all-time high would make you nervous. You have to pay, if you want to own stocks today, you have to pay a higher price than you've ever paid before. It can make things feel toppy. It makes it seem like we're due for a correction. But the reality is all-time highs or the indices pushing new highs is a normal feature of the stock market. In fact, if you looked at over the last 12 years, 11 of those years, the market has established an all-time high in 11 of the last 12 years. So it's a very common occurrence. And I think that makes sense, right? Because over time, the economy is growing. And businesses are making money and they're investing those earnings back in the business. They're growing their business, they're growing their earnings streams. Those earnings, higher earnings, justify a higher price, right? And that's why valuations are so important, because you can't evaluate an investment solely upon looking at the price. You need to understand what you're receiving for the money that you're investing, right? So a valuation ratio puts the price into the context of the fundamental value that you're receiving. And so when we look at, okay, let's look at the last 100 years of history, right? And all the all-time highs that we've hit, we can see how the market has performed 1, 3, and 5 years later, looking at this chart, with the green bars showing what the return was following an all-time high, and the red bars showing what the return was basically following any other month. And what you can see is a year later, the market actually tends to do on average a little bit better coming off an all-time high. And I think that just demonstrates the fact that there is some degree of momentum within the stock market. Momentum is a real thing. When you expand that window out a little bit to 3 to 5 years, those returns are, following all-time highs slightly below the other months, but I would generally say that those returns are very much in line with each other. To me, the key takeaway from this chart is all-time highs in and of themselves is not a cause for investor concern in the stock market. And this will be kind of the last chart, so we'll leave you with this. But here we're looking at valuations. And here, I think we do have perhaps a little bit of cause for concern. When we look at the bond market, if yields are the best predictor of bond returns, then within the stock market, valuation is the best predictor of stock returns. And right now, in aggregate, in the US market, valuations are very expensive. Higher valuations lead to lower expected returns. Low valuations generally lead to higher expected returns. But when you drill down beneath sort of that broad definition of stocks and you get a little bit more granular, you can see that that story is not consistent across every area of the stock market. Certainly large cap growth relative to history, relative to the market is very highly valued. But when you look at areas like international stocks, value stocks, small caps, mid caps, these other areas, the valuations are much more attractive.
And this is a relative valuation relative to number of different sectors of the market at Russell 3000.
That's exactly right. So all of these basically is the valuation of each of these smaller, more granular definitions or buckets relative to what the market is.
And for those small cap value would be a smaller company by valuation. I shouldn't say by valuation, by market capitalization would be like a local company like Werner Trucking would be in that mix. Large cap growth, there's where your NVIDIAs and your Microsofts and your Amazons fall.
Yeah, exactly. So when I think of large cap growth, I definitely think of all the Mag 7 stocks. And then even some of the AI type stocks, I kind of bucket into the growthy segments as well. And, I think there's some general concern right now about sort of a lot of the CapEx that's going into the AI. Right, there's these big companies are spending hundreds of billions of dollars a year to build out the AI infrastructure. There's not a lot of revenues, at least yet, to show for it. Some people are concerned, hey, is all of this investment going to generate a sufficient return? I don't think there's anybody out there who believes that AI is not the real deal and that I think most people believe that it's going to be a game changer for us personally, for us professionally, like it's the real deal. But when you compare it to other big technological advances that took in huge sums of money to do the initial build out, I think about the internet back in the late 90s. You can't argue that the internet didn't change everybody's lives, right? We wouldn't be doing this webinar if it wasn't for the internet. But the sheer amount of overinvestment and speculation in internet infrastructure and internet related sort of .com companies still ended in one of the most famous bubbles bursting in sort of market history. So I think there's some echoes of that with the AI. There's no matter how good the idea is, you could send too much money after it to where you're not going to get a sufficient return on that capital. I don't have strong conviction one way or another. I don't think anybody truly knows how it's going to play out. But I think that's kind of the beauty of diversification, right? You don't have to make the binary decision to be all in or all out of AI related investments or Mag 7 related investments. Own the market. So you own some of these companies. If it continues to generate good returns, then you're going to participate, but tilt portfolios to some of these other areas with attractive valuations. And if it ends up being, a bubble, then you're going to be insulated in some of these other areas. When the NASDAQ imploded in the early 2000s, small cap value had extremely strong returns. So that's, again, the beauty of diversification, and I think tilting towards certain areas of the market.
With that, I think we've got a polling question that we're going to have to make sure you can earn your CPE credit for those of you who need that. Tough question. Are you still listening? So wake up, answer the question if you need the CPE. All right, I hope everybody got that right. So as we progress on, I think this part of the review and planning session is kind of, applying some of the year-end things that we do here with portfolios and clients and on the tax side and everywhere, just to kind of advance us in and prepare us for year-end. There's been a lot of things going on. Obviously, Josh told you about what's gone on in the markets over the last 3 years. So, I always take the time for year-end to really look at portfolios and where we need to rebalance. I mean, if you haven't touched your portfolio for 3 years, you've had really good successive equity performance. Is it time to go de-risk that back and mow the grass per se and say, hey, you know what, I need to do a little rebalancing and take my portfolio back to the target risk. Otherwise, I might be over allocated to stocks or to something that could be a little higher risk that could have a pullback or something on the road. So, I always take to say, okay, is this what I want my portfolio to be like? And if it's not, what do I need to do to get back there? So the other thing I'd look at is, Josh mentioned that rates are falling. As rates are falling, so are payments on cash balances and some, interest earning vehicles like CDs and money market funds and bank accounts and things like that. So I always take the opportunity at year end to kind of look at those and make sure I'm in the appropriate vehicles for those as well. And do I need to move into a position traded money market fund that earns a little bit interest in the brokerage suite? Obviously does. Or maybe even I've accumulated some cash at the bank that I need to put to work per se a little bit more. So it's a good opportunity to do that. Inside of taxable portfolios, towards the end of the year, you often see some of these older mutual funds and things distributions. They have to distribute legally any churn that they have inside of the positions inside of the portfolio. If there's capital gains, those have to be distributed out to the holders of the funds. And you might not make a trade at all, but they might be distributing out some of those capital gains. Starting in November, you'll start to see these funds announce some of these capital gain distributions. And so it's important to be aware of those before you hit April 15th. And then April 15th, you get a surprise tax bill that you weren't expecting. So definitely look and see if those funds are making those capital gain distributions. The other thing is doing tax loss harvesting. We've seen a volatile year in March and April. We had some positions at losses. So you raise and harvest some of those amounts and then go into not the same security because you can't take the loss. That's called a wash sale if you buy or sell and buy the same security, but some other different types of security, maybe you don't like it, or maybe it's something that's in the same sector or whatever, where you can recognize that loss for tax purposes to potentially offset some gains and then reinvest so you're not completely out of the market for an amount of time. So looking at those harvesting opportunities is pretty tough sometimes on a bull market like this. But you never know. Some sectors haven't performed quite as well this year as some other ones have. So looking at those taxable or tax loss harvesting opportunities is something else we always look at. The other thing is working with your tax professionals, specifically on IRAs, 401ks, retirement account. If you're a retiree or getting close to retirement, you should look at doing some tax planning, and we have people actually leak out some distributions if we think they're going to be at lower tax rates this year versus future tax rates or versus there's been some tax changes that potentially will lower the tax bill potentially from last year. And do you want to kind of take some of those distributions out this year to kind of smooth out future tax years? So you got to understand, and this is hugely important, the effect of that distribution to your income as it affects some of these phase outs for some of these deductions that we'll talk about here in a second. And then how it affects your potential capital gain, or your Medicare premiums and any ACA subsidies that you're receiving for your healthcare plan, how that capital gains and how those income distributions would affect that, and making sure you're not tanking anything unbeknownst to you to cause your premiums to go up or subsidies to be lost, or your phase out on some of these deductions. So really important planning, but really careful planning as well that you need to kind of look at with some of those things with your tax professional. The other thing we wanted to talk about is probably the biggest change that occurred this year, and that's the one big beautiful bill act that they passed about mid-year through Congress. I would say what it did, the main thing it did was extend some of the things that was already going on, specifically the current tax brackets. They were scheduled to sunset back to the pre Tax Cut and Jobs Act tax brackets that we had years ago, where every bracket would have been roughly 2 to 3% higher than they were scheduled to be in 2026. So they maintained those brackets through 26, obviously, and through this year. So that's probably the biggest thing that affects the most people is those are just extending going forward until the next new tax bill. But the other thing they did was they raised the estate and gift exemption to 15 million per person, which was also scheduled to sunset in 2026 to be less than half of that. So a lot of people's estates now don't fall under that potential for estate tax, either during their lives or when they pass, during their lives when they gift or when they pass. So those are probably, in our eyes, the two bigger things that kind of continued on with this tax passage that everybody's like, yeah, it's kind of ho-hum, didn't really affect me, but it really did affect everybody. And those are two of the biggest provisions that come out. Some of the other things I think we want to take from it that I think is important and will affect a lot of people, specifically is this state and local tax deduction limitation. It was at $10,000 last year. So your state and local taxes are your real estate taxes and your state income taxes primarily. In Nebraska, we know that those two bills are pretty big in everybody's eyes. So in 2025, this begins this year, that has gone to $40,000. You can deduct up to $40,000 of those state and local taxes against your federal tax return. That's up from $10,000 last year. The caveat being is those phase outs start beginning at $500,000 of adjusted gross income. So if you're above $500,000 of adjusted gross income, you're potentially capped at that $10,000 that you were last year. So anybody making less than that, potentially you're going to increase that SALT deduction to $40,000, which is very significant, which probably puts you in the itemization side of the things to the extent you have larger state and local taxes. Again, back to they increased slightly on the standard deduction. So married filing jointly, that's $31,500 and $15,750 for individuals. So you can see if you do have a large state income tax or a large real estate tax in your world, you're probably going to be above those standard deductions just with the SALT exemption or deduction, I should say. So that's a big deal and something seriously that has changed from last year to this year when you're planning for your taxes. That this might push you into that itemization category that maybe you weren't last year. The other thing, and this is kind of one of those things that rolled forward again, they did have an elimination. They used to cap itemized deductions for those in the top brackets. But instead what they've done is effectively cap that benefit of those itemizations at the 35% bracket, not the 37%. But are letting those itemized deductions still continue and not capping those out like they were. So that is extended. And one kind of little nuance that I think is important for people to think through is next year, there's going to be a 0.5% AGI floor for itemizers. What the heck does that mean? Let's take the example, you make $200,000 and you try to itemize your first $1,000, 0.5% of $2,000 or $200,000 is eliminated from being deducted on that. So it's not huge. Frankly, it's fairly inconsequential, but it's at least something to think about. You will not have this year that you will have next year's going forward. And going back on the SALT too, I forgot to mention this. This schedules to revert back in 2030 to $10,000. They could not carry that forward indefinitely through the bill passage. That reverts back in 2030. So you've got a window here from 25 to 30 that you get that higher standard local or state and local tax deduction. So a couple things going on there. So these things are going to make deductions and planning your deductions, how you do it on an annual basis, specifically whether you're itemizing or taking the standard deduction. is probably coming more into play than it has been, just given the changes that have occurred with this new bill. Couple other things that we just wanted to mention, and we're not going to get too in depth with these, but are also issues that this bill has brought forth. The enhanced deduction for seniors is a $6,000 deduction per person that's over 65. And these phase outs, again, these are income phase outs, begin at 75,000 for a single person and 150,000 married filing jointly. But this is kind of the workaround when they were trying to eliminate tax on Social Security, that they're able to put this deduction through that would reduce obviously your taxes, because you're going to get an extra deduction to offset for those seniors that are 65 and older, that they'll get this year. And that begins this year and ends in 2028. Again, not permanent. I just got to make some moving parts, I guess. But at the same time, you're going to have the opportunity this year for that extra deduction, assuming you fall under those AGI limitations. The other thing that we're going to talk through, there's no tax on tips and overtime. There's a handful of different income levels that this will affect and not affect. So these are above the line deductions that you'll get on those tips and overtime. Again, you got to fall into a specified amount of adjusted gross income for that to happen. And then the big one that people have talked about is the deduction for car loan interest. Again, these are all 25 to 28. They're not permanent, but basically you get a deduction for car loan interest up to $10,000, assuming that the final assembly took place in the United States. And they have a whole list of different cars and VIN numbers that they will look up, that will have to verify that, okay, this is what my car loan is on, and this is the car that I have the loan on that was assembled in the United States, and I get this deduction. Again, subject to an AGI phase out of $200,000 filing jointly and $100,000 individually. So again, a lot's going on here. You need to talk to your tax professional to make sure you qualify, or to see if you qualify for it. And then 2026, this is the above line charitable deduction of $2,000 married filing jointly that you'll be able to get even if you take the standard deduction for charitables, but that is not effective till 2026. So a ton going on with this bill, a ton of changes and things to kind of keep and talk to your professional about, but to keep in mind as you're ending the year. Because I think for a lot of people, their taxes might be in a little better position from a deduction standpoint than they were last year. So potentially lower taxable income, which is why we go back to, hey, if you're a pre-retiree or retiree, do you want to leak out some extra distributions this year? Because you potentially are at lower tax breaks at that point. So the other thing, with obviously all the things going on taxable and deduction wise and everything like that. Another thing that we think as you approach year end, you need to look at is charitable planning. Everybody does it. There's two things that are fairly new, or I should say newish, that we are talking to a lot of people about today that I want to make everybody aware. But if you're over 70 and a half years old, you have the ability to do charitable donations from your IRA. It has to be from your IRA, and this is what they refer to as the qualified charitable distribution. So instead of writing a check from your checking account, you actually issue the check from your IRA, and you work with your brokerage provider to do that. So this is subject to a $108,000 maximum. But at the end of the day, what it does is can reduce your taxable income or lower that RMD that you need to take in order as you do those charitables. If you're below 70 and a half, or for other reasons, and you have appreciated a stock, specifically with this market run, we're seeing a lot of folks with some of these semiconductors that we're opening up donor advised funds to push over some of those appreciated stocks into the charitable bucket. Again, they get the deduction this year and avoid the capital gain to the extent they're now phased out. That they avoid the capital gains on those stocks, and then it places into an account that at any other point in time in the future or now, they can make charitable distributions to their favorite charities as long as they're a 501c3. But it allows us to do that this year and itemizing a good year that's prior to this AGI floor for 2026. So you can kind of lump these into this year, take a full itemized deduction, and then maybe take your standard next year and the year following or whatever. So there's a lot of options available to you through Omaha Community Foundation, Schwab, Vanguard. And so you talk to your tax provider or talk to your investment advisor, and they'll recommend the one that may be appropriate for you at this point. But two ways to really optimize charity in our eyes, whether it be reducing your income from the IRA's perspective or avoiding the capital gains and taking a full deduction on the donor advised fund side. Lastly, I think that what we should look at is kind of 401k plans, and this is something we do here, and we're happy to discuss this. But there's ways that you can formulate these 401ks that allow for higher contributions, and these are after-tax contributions that are subject to 415 limits that could potentially allow you to defer $70,000 potentially into these plans up to that. Now, your elective deferral at the bottom here is $23,500, and the catch-up at 50 plus is $7,500, and the catch-up for 60 to 63 is $11,250. But ultimately, those are the ones you're able to put into the 401k. This, profit sharing new comparability plans, if you do them right, you potentially can allow yourself some after-tax contributions. Again, there's got to be a lot of things going on there, but it's something that we're seeing more and more people do, which allows for some mega backdoor Roth when you convert those contributions inside of the plan. Lots going on there that we're not going to get into a lot of detail on. We would just say to talk to your tax professional and potentially your 401k plan representative or TPA that could potentially allow this if it's suitable for the business and your business at this point. That being said, if you don't have a 401k plan, there's some tax credits and some incentives to do so this year still. You got a very little amount of time to be able to do that, but it's something to consider. And then on the solo 401k side, if you do have kind of income or you're self-employed, you can open up potentially a solo 401k if you're a 1099 person, if you don't have any other 401ks available to you at this point. So consider that, but a lot of things to do within, and make sure you've made your contributions if you think you're maxing it out and contributing before year end, because you won't be able to go back and do so. So always something to think about as you get into year end with your 401k. And again, lastly, speaking of the employer benefits, again, go check it. We get stale, we get into a position and we don't really we think we got everything taken care of, but looking at long-term disability is a big deal that we see holes in people's plans. So making sure if you have that available to you, you've elected it, or you know how much you have, just to make sure you may not need more. So look at that as a course of year end, and when you re-up your benefits, this is something we would say to make sure you take a look at. Healthcare, the whole budget impasse right now and the shutdown in Washington has to do with partly to do with these ACA plan subsidies. If you're getting a subsidy now, there's a chance you might not be able to get it if it sunsets like it's supposed to in the next 2026. So be aware of how much impactful those things could be, depending on how this budget impasse goes and this shutdown goes, and who ultimately caves on the ACA subsidy, because it could change dramatically. So we're making sure people are aware of that. And then finally, there's some tax changes that have changed the estate value calculation in cross-owned life insurance between partners inside of a business. I would suggest if you have a key man or cross-owned life insurance inside your business, you talk to your attorney, your tax advisor, to make sure that's not going to be impacted. So with all that said, I think we've got a couple questions already. So we appreciate everybody's time. If you're going to go, thank you for joining us. Please give us feedback on what you liked, what you didn't like, and what we can do for the future as we kind of do these things and make the fourth annual better and more impactful to what you have. So first question for Josh: what do you see concerning the gold and silver markets?
Yeah, I think a chart on gold, if I were to have had another slide in the presentation, we definitely would have been on gold gold and or silver. Obviously, gold's done incredibly well this year. I think it got a lot of sort of media coverage when it crossed above 4,000. I think it's up, 50% or more this year. Anytime you see gold go on a big run, we tend to get that question: do I need to have gold in my portfolio? Taking a step back, I mean, there's a lot of reasons why gold's probably doing well right now. I think there's a lot of sort of geopolitical concerns. There's probably some concerns about dollar weakness. You've seen a lot of central banks doing a lot of buying in gold. And then even, looking at like GLD and some of the ETFs that own physical gold here in the US, again, you've seen big flows. I think that probably goes back to more of the dollar and geopolitical fears. Our view is that you want your investment to produce cash flows, right? You want it to be able to generate cash flows so you can reinvest those cash flows for future growth and enjoy those compounding returns. That's a key feature in our view. What an investment is. Gold lacks that feature. Basically, with gold, you're dependent on somebody else later being willing to pay you a higher price than you paid for it. When you have these periods where people are kind of rushing into it, you can see the price of gold pop. But in my view, that's not sustainable. You could see, gold could go up much higher from here as it gets a lot more attention and more people pile on the trade. But in my view, that's not a sustainable source of return, and it could reverse as quickly as it started. Again, we look for, things that produce cash flow, things that can grow, things that can compound.
In my personal opinion, I don't own any gold, so I'll speak for myself. The reason I don't own any gold is, again, to what Josh said, it's worth whatever somebody else is going to try to pay me for it. If the reason you're owning gold is because you have fear of the dollar, you have international investments that are paying dividends and things like that are a counter hedge to the dollar because they're making other currencies. You have other things. I have short-term cash that's paying me a rate of interest every year. If the dollar really erodes, interest rates go up, they're going to pay me more interest over time. So again, I think there's other vehicles that provide the same thing, that pay me interest or pay me a dividend or pay that it's not just a speculative one. So
one thing just to add to that too, look, if you want to own gold, that's fine, right? Like the gold is not like, something that you should avoid. It's not necessarily detrimental for you, but just size your ownership appropriately, right? Like 3 to 5% of your investable assets is probably reasonable. Again, it's not something that we do or recommend, but if you size it appropriately, it's not a big deal. And I think we just got the question, hey, if you owned it already, is now a good time to sell? And my response to that would be, it's tough. Don't want to provide specific advice, but I would wonder, again, what portion of your investable assets is it? If it's large, maybe a good time to trim. Why do you own it in the first place? Is the reason you bought it initially, has that changed? Is it a small amount that you just want some kind of uncorrelated asset? Then, you don't necessarily need it to sell right now. And the last thing is, what's going to cause you more regret in the future? Are you concerned? Would you be more upset with yourself if you sold it and then by the end of next year it's at 5,000? Or would you be more upset with yourself if you kept it and next year it's at 3,000? Right. So some of that, sometimes in investing, and this is again goes back to diversification, it's a little bit of regret minimization and not making binary decisions.
Yeah, I don't want to get into specifics when I sell it or buy it or anything like that. I told you what I do. I don't own it, but at the same time, I always ask myself with any investment too, at the level it's at, would I go out and buy the same amount that I own today in that? And again, there's tax considerations and all other considerations, and specifically as it relates to your overall portfolio and how that interacts with your portfolio, that's the biggest consideration. That's why we can't give specific advice here, because I don't know what else is going on in your world, and all of that impacts what we would recommend. But at the same time, I always ask myself with any investment, okay, would I go out and purchase that today at the value that I have it today? And if I do, then I keep it. If I don't, then I trim it or do whatever. And probably the answer is not absolute yes or no. It's maybe, okay, to Josh's point, do you hedge it? Do you sell a piece of it? Do you trim it back? Just like we talked about rebalancing. If it becomes an outsized portion of your portfolio, do you want to trim that back? That's something else to consider.
I think one thing too, from a tax perspective, and I'm not a tax accountant, so consult your tax professional, but I believe if you own physical gold, it's taxed as a collectible,
Yeah.
which is a higher rate than long-term cap gains.
So it's 20%.
Yeah, so that's something to consider as well, the tax ramification of it.
Some of the other folks, for portfolio allocation, how do you see alternative investments, specifically real estate? I think alternative investments is a big, broad word. I think just like anything, it's dependent on the amount you have inside of your portfolio, what the other asset mix is. You know, most people have real estate exposure, and that's sometimes a bigger portion of their assets, which is their house. I don't know if that's alternative, but that's a utilitarian asset. But you know, that's a big word, and I think specifically, I think there's a time and a place for a lot of those things inside of a portfolio, and I think it's dependent on the other assets. And then I think it's dependent on what actually that alternative investment is. There are certainly things that we see, and we see a lot of different proposals and different things that I wouldn't touch with a 10-foot pole. And then there's things that are very intriguing. So I think it's at the end of the day, there's a combination of all those for the answer. That's not me hedging or not answering the question. It's just saying that's a huge word, and specifics really matter at that point.
I think it's important to remember too, if you have a diversified equity portfolio, then you're going to have exposure to publicly traded real estate. So through REITs, now that's not exactly the same animal, but you definitely are going to have some real estate exposure anyway. As Justin mentioned, Alts is a massive umbrella that includes a massive variety, a huge spectrum of different types of investments. I think I've got somewhat of a personal bias that a lot of alternatives are better for the people who are selling them than they are for the people who are buying them in terms of just really high fees. I think for a lot of people, being invested appropriately in the public markets is going to get you where you need to be, with very large balance sheets and wealth that's going to span across many generations. Then maybe you think about some ways to get some less liquid assets. But I think for the majority of people, the public markets is a phenomenal way to build wealth.
Looks like I think we've answered all the questions. And again, on behalf of Josh and myself and Lutz, thanks again for taking time out of your day to join us. And obviously they'll be following up with any some information, and I think the presentation itself, which has our emails and phone numbers and things that you can reach out if you have any further questions, or obviously call the main line and get you to the right spot. So again, thank you for joining us, and have a great end of the year, and look forward to seeing everybody again. Thanks.
Thanks.